Okay, listeners, we're back for another great podcast for your Smart Retirement podcast here. It's Mike Points, and I'm with my co host, Matt Hollander. Mr. Matt Hollander, before you say anything, I got to say it first. Happy birthday, my friend.
Thank you, Mr. Mike. Thank you. Uh,
And so you can now legally drink, right?
right. Yeah, that's what they tell me.
Oh man. For those of you that don't know it, Matt is a young professional on the fast track to success. He's still under 30 and knows more than people that are over 50.
Thank you,
So
Mike.
pretty cool. Matt, happy birthday to you. I know that you are probably going to get out to grab a quick bite to eat with your friends. And today, after a holiday weekend, we'll probably make this recording a little bit shorter, wouldn't you say?
Yep. First day back in the office today. Took President's Day off. Took a long weekend for myself. So, yeah, we'll make this one kind of quick and simple. I know there's some things that I'd like to touch on. We're
Yeah.
going to be doing a multiple part series episode coming up here again and kind of just use this episode to kind of premise what we're going to be talking about there. But what's been going on in the office today for you, Mr. Mike?
Yeah, so mortgage industry is booming still. Since March of last year, it's been, I would say, about 300% capacity. So what we do in a year, we've done three times that in 2020. This year, it started to slow down a little bit, but what's interesting today specifically is that I've been warning some of you that are my clients, or if you follow me on Facebook, I've been warning that, as soon as this 10-year Treasury note goes up above 1.2, we're going to start to see lenders really tighten up what their rates could be, because a lot of these lenders have made tons of money, millions and billions of profits on the refinance boom that's taken place during the pandemic. But at some point it's got to give, right? They don't want to be refinancing the entire market at 2.5%. It's not good for their income model. So today we saw some stress in the marketplace, and the 10-year Treasury note actually jumped up to 1.3. It started at 1.19 last week. It dropped down to below 1.1, so it got down to like 1.05 at one point. And essentially, this is just an index, right? So it moves every day. So, I mean, tomorrow I could be laughing at myself. It could be back down to 1.10 again. But today it went all the way up to 1.3. And those of you that I've been kind of coaching and letting you know, hey, if you're waiting to purchase a house for the first time, or you're waiting to do that refinance because you want to see rates get lower, this week could be a week where we actually see interest rates go up a quarter, maybe 3/8 of a point in interest rate. So if you had a quote that was valid at 2.625, you want to jump on that, because it could be 3% by Thursday or Friday of this week. We just kind of have to see how it all shakes out. Why is this happening? Well, the 10-year Treasury note is really a reflection of how well the U.S. economy can pay back their bondholders, right? I mean,
Yep.
it's kind of what it is. A Treasury note is much like a bond. And with the optimism and the current success of businesses just learning how to operate while social distancing, we're starting to see that come back. Also, we've got the vaccines are out and about, albeit each county a little bit more disgruntled than the other about how their vaccines are getting given to their citizens. It's still out and about and breathing optimism into this machine known as the U.S. economy. That's on a macro scale. On a micro scale, I just got off a great phone call, Matt, with a listener that's called in they listen to the show. They actually live in Turlock, California, so that's out in the Central Valley
Yep.
near Fresno, probably the biggest landmark you could think of. And their parents had a property in Templeton, so near and dear to your heart.
Absolutely.
And for those of you who don't know, Matt grew up in Templeton, went to Templeton High in California, and I think that she's been, since December of 2019, Matt, she's been dealing with the rigmarole of when mom passed away. They knew she was going to pass. She had to go through the full process of, getting the death certificate, providing to the estate attorney that, this is a new thing to do. We've got to move the properties now because she's a sole beneficiary, no siblings, and fortunately in her case, no real liens on the properties. So It's going to go straight from trust to her now as she's the trustee and the beneficiary. And so she's converted that all over, but now what she's finding out, there's a little bit of a snag in the way you do things, because banks want to make sure that you are the only owner, right? That you're not telling us that there aren't any siblings, and we need to make sure that you've been on title long enough, or at least been paying the mortgages or the actual, liabilities of the property for the last 12 months. So I was going through that conversation with her. It was an intro call, so I hope that she liked the way we touch on estate planning in the show. She liked the way that we bounce back and forth between, investments and liabilities and mortgages. So she gave us a call. Very cool. And listeners, you can do that as well. Matt and I talk to listeners from all over the state. You can call in by dialing 866-53-RETIRE. Option 1 gets you to our birthday boy here, Mr. Matt Hollander. And option 2 gets you to me. We're working with an attorney out of the state of Massachusetts right now. She's dealing with some of her retirement accounts. She's trying to get a refinance. Sorry about that. From one of her retirement accounts, really is like her investment properties. She's trying to get a refinance, but as she gears up for retirement, she's showing less and less income. So we've got people down in your neck of the woods all the time, Matt, calling in about things like, what are real long-term care costs and what are health insurance concerns. And you're the type that does seminars, now webinars, due to the pandemic, on this very topic. I mean, if you could just tell us a little bit about you and your dad and the company and where you guys really do specialize.
Sure. Yeah, I mean, that was one of the big things that when I first got into this industry was focusing on the long-term care aspect of things and healthcare costs in retirement. It's one of the things that I think realistically is not looked at by most financial advisors well enough, when it's simply one of the biggest things that could really destroy any retirement plan that's out there.
Right.
Long-term care costs today, I was looking, the national average for long-term care, let's see if I've got that here, median cost for a private room, let's say if you had to go to a nursing facility, right? It's about $8,800 a month, right? So talk about a huge amount of money that most people are not even prepared to even pay 50% of, right? And even home health care is the national average is almost $4,600 a month. That's I think that's probably more than most of the people I sit with mortgage, even with property taxes involved, right? So, that's kind of worrisome, right? And they've done studies on this, and they're saying that 70%, if somebody lives to 65 today, they have a 70% chance of needing some type of long-term care during their retirement and the rest of their life, right?
Right.
Now, so was that maybe 6 months? Is that a year? Is it
Yeah, it
2?
could be intermittent, could be
I don't know,
forever.
right? And we talk about this all the time, is not having that crystal ball when it comes to what the stock market's going to do. Well, I don't have any crystal ball as far as what people's health is going to be like. Doctors have definitely helped advance things over the years. People are living longer, of course, right? But there's also still no cures and things out there for things like dementia, Alzheimer's, right? And those are things that, they're catastrophic illnesses, right? Because it simply is, if you've ever had a family member or anything, it's not only catastrophic for what they're going through, but then what it does to their loved ones, their finances, and everything else. So one of the things that I did starting out in the industry is got a designation behind my name. It's a certified Medicaid Medi-Cal planner. So essentially, there are things, if someone, let's say, can't afford or doesn't want to go ahead and pay for long-term care insurance, there are some ways that you can shelter your assets now for if that event were to arise later, right?
Yeah.
And you've been in those workshops with me before. I've done them all over this country. Spent a lot of time up in the Midwest. Spent a lot of time out in California, Arizona. In most every state, I will say for you listeners out there, I can help you plan and get a little bit of an idea of what might be able to be sheltered and what couldn't be, with probably about a 10-15 minute phone conversation. So, long-term care, of course, near and dear to my heart. But I will also say that if you have a long-term care insurance policy and you're listening to this show, and you say, Matt, I've had this thing for 5, 6, 7, 10 years now. Is it going to be up to date with the rising healthcare costs? I don't know. That's a simple phone conversation. So, like Mike said earlier in the show, give us a call, 866-53-RETIRE. Again, that's 866-53-RETIRE. Option 1 will get you direct to me, Matt Hollander, and we can have a little conversation. Let's see if your long-term care is up to date. Let's see if you've got all the coverage that you need, and really just kind of have a conversation about it. And if you don't have anything currently, well, let's talk about it. What can we do? So, and I
I
think
mean, healthcare. Go ahead, Matt.
no, go ahead, Mike. What were you gonna say?
Healthcare costs in retirement, because they're such a difficult thing to budget for, is one of my main combats or main ways to counteract those costs is to have liquidity. I personally don't like paying a large premium for insurance because most of the insurance companies I've seen deal with, it's not that they don't pay out the claims. It's just that they're very, very, very intelligent with their actuaries as to what could be a risk. And I mean, it sounds like I hate insurance companies. I don't, but I would rather you take some of the control, at least the immediate control, into your own hands. And what do I mean by immediate control? I mean, like you said, 70% of the people that are over the age of 65 are going to have some type of long-term care. Now, if we want to look at how many of them have to go into like day after day after day forever healthcare, it's probably a smaller slice of that population.
Sure.
But I can assure you, I've seen it myself with clients, the fall down, right? Or the illness or the weird stroke that leads to a 6 to 8 month ordeal where my spouse cannot provide care for me. Guys, liquidity is the perfect thing for that. I mean, it may cost $60, $70, $80,000 for just 6 months of care. And so having some balance in your portfolio where you don't have to worry about selling Apple stock, but also having the access to a home equity line of credit where in a house that you've owned for years that has $600,000, $700,000, $800,000 in equity, it just makes real good sense to have access to that. Now, do you have to go out and get one now, or should you wait till you have the health ailment? I would just get one now. I mean, here's the thing. You don't have to have a balance now, right? You don't have to have a balance. Well, Mike, the home equity line of credit's, it's cumbersome. I don't want to go and do it. I get that. That's why you would call in and talk to someone like me. I could walk you through the pros and cons. And here's what comes up when you start talking about borrowing money, right? Well, we have been meaning to put that spa in the backyard, or we have been meaning to, touch up the guest room so that it's a little bit more ADA compliant. We can do live in place stuff as well. So it's we're going to start this series, Matt. I'm going to let you kick it off properly next week, but it's going to be about prepping yourself for these, I call them landmines in retirement.
Yep.
Somebody smart doesn't go to war and just assume that there's no landmines or bombs or things that are going to come out of left field to derail the mission. They're going to go in prepared. They're going to have contingency plans, and that's what Matt and I like to set up for you guys.
Yep, absolutely. And one of the things that I did want to bring up today, at least, it's not a real long topic, but I think one of the main concerns, even with going along with the healthcare, long-term care, whatever it may be, is right. Everyone's number one concern going into retirement or in retirement is what? Like running out of money or running out of income.
Income, right? Yeah.
And with fewer and fewer people these days, I'm not going to say having availability, but less and less I'm seeing have 401ks. They're having to self-fund themselves in, SEP IRAs, traditional IRAs, Roth IRAs, etc. And they don't quite have the contribution limits necessarily as a 401k might, but then they also don't have the employer contributing with them, right? I mean, I'm seeing fewer and fewer people with pensions, etc. So it's really important to not only be planning for this healthcare element or long-term care issue that could arise, but really focusing on what you might have available to you when it comes to income in retirement. So one of the things that did come across that I was reading the other day is, Mike, you and I have touched on this, the Secure Act that was put into place, which was the Setting Every Community Up for Retirement Enhancement Act that was passed this back.
The
I guess
2020 or was it
it was
2019?
2019 came in at the
Yeah,
beginning of 2020, right? So
right.
there were some rules there. They changed, how quickly you had to take money out of an IRA if you inherited it, etc. But one of the really cool things that I saw that they're actually going to start doing inside of this is, and I'm guessing this is going to be probably third quarter of 2021, maybe creeping into fourth quarter. But plan administrators are now going to be required to offer at least two different types of annuities inside of your 401k. So for somebody that's, hey, I put all this money into my 401k, I've set it, forget it, I'm going to retire, I want to take money out of it, right? And I see that so often. But the problem was there's so many people that don't come to people like myself to do proper planning. So now what are they stuck with? Well, now they have this large sum of money in this 401k. How do we know how to take it out, right? The old rule was 4%. You take the value of the account, take by 4%, and that's what you could take out a year. But with the volatility in today's market, rising healthcare costs, it really makes it hard to determine how do we do it. So these plan administrators are now going to have to give you on your statement an idea of if you took it out on a lifetime benefit, what it actually means for income. So for those of you that are decently savvy, now you're going to be able to look at your statement, get an idea of what income is going to look like in retirement on top of maybe your Social Security, if you've got a pension, etc. So I really think it's going to be a really good planning tool for individuals out there. So as they start rolling more and more regulations out and rules on this of what they're actually going to have inside this, I will be bringing this back to you all so you can kind of understand it better, walk you through it. But it sounds like basically they're going to give us an option to where it'll show you your life or they call it a joint life with survivorship. So essentially that means it would go to you until you passed away, and if you were married, it would then continue to your spouse. And of course, that's going to be a little bit of a reduced amount should you decide that go that way. So as that information becomes more available, we will be bringing that to you. But as Mike said, for March, I really want to focus on some of these issues that can come up in retirement that really can derail that train. So with that, Mike, I wanted to keep this, kind of a short episode. Listeners, as always, if you've got any questions, concerns, phone us in 866-53-RETIRE. Again, that's 866-53-RETIRE, or shoot us an email at info@smartretirementcast.com. One thing I do want to throw out to all you listeners, any of you that are watching this on YouTube, down on that bottom button, hit subscribe. That way, when we release new content, you'll be notified. Also, join us on Facebook. Check us out on there. Mike and I post articles there pretty frequently of things that we're seeing online that maybe is not necessary for a whole episode, but maybe a good little 5-minute read for you. So, Mike, with that, anything else you'd like to add?
Yeah, I just want to mention that, right now, this time of year, it's starting to really creep into your to-do list is to get your 2020 taxes done.
Yep.
Some of you are thinking, oh yeah, I'm going to extend. I always extend, and that's fine. But I think it's a good time for you to reach out to us as you're preparing your 2020 taxes because you'll have your ducks in a row, you'll be orderly, you'll be either meeting with your CPA or just met with your CPA. Matt and I look at tax returns and income statements all the time. That's like a big part of our jobs. And I want you to be able to feel comfortable reaching out and talking to us like, hey, here's where I'm at. Let's do like a really good checkup, almost like you'd go see your doctor. Maybe I don't have any products with you, Matt. Maybe I don't have any loans with you, Mike. But if I were to do something, how do I look? Like, what would you do differently? I think because it's on the forefront of your mind this time of year, more so than any, because you're really forced to get the stuff in order and it's been coming to you in the mail in January and now you've got everything. That would be a good way for you to call in and connect with us at 866-53-RETIRE. You could also email us info@smartretirementcast.net.
.com.
.com. I did that on purpose. info@smartretirement. I think listeners probably are laughing at me by now. I think I've never said that email once
I
correctly.
think I need for in the future when we record, like have you put a little Post-it note on top of your computer screen so that way you've got it.
So it's info@smartretirementcast.com.
You got it.
Cool. Matt, I want to say happy birthday to you. I appreciate all that you do to help us with the show and just being a great co-pilot with me. I hope you have a great evening and a happy birthday.
Thanks, Mike. Listeners, thank you for tuning in today, and we look forward to catching you on the next episode of Smart Retirement Podcast and helping dive into some of these retirement derailments, we'll call them. So let's go out and make the rest of our lives the best of our lives. Thanks for tuning in.